Hi everyone, my name is Piterpakulski. Today we have a final overview of a subscription financial model. I will give all the links in the description of this video of the process of creation of this model from scratch till the cash flow statement, so you can have a long walk through the beginning till the end, see how it is being made. So if you find this video valuable, you may give us a like, subscribe, share this video with your friends, you can write a comment, you can order a financial model from scratch for your unique business idea. And today I would like to show you what parameters affect financial efficiency of subscription business model. Let's go input by input, and I will show you how it's made. So first of all our inputs are colored with specific blue color, like this, like this, like this. So all other cells are automated, so we don't need to put any inputs inside these cells. So we are putting numbers and data only inside blue color cells. So first of all, we specify the first year when we start investment stage in our project. Then we specify when we get the first revenue, so when the operating activity starts, month and year. Then we have for example several types of customers, and they have different financial behavior if we are talking about the revenues. So each type of customer has its own payment value. Some of them will pay us once in 3 months, some of them will pay us every month, some of them will pay us, for example, once half a year, some of them will pay us once a year, so we can specify the period of payment. Then we can specify how long each type of customer stays with us, and so we can specify the life cycle of each customer type, when the customer disappears and ends up with the revenues, giving us the revenues. Then we can add coefficients for payments to play with these numbers. We can increase or decrease these values using these coefficients to create different scenarios to play with numbers. Also, we can switch on and switch off different types of customers from calculations to see what will be the simple and discounted payback period, what will be the financial efficiency if we switch on, switch off different types of customer. Also, we can we have a coefficient for increase or decrease general amount of new customers, so we don't have to type. So first of all, of course, we can so this is the month, these are the months of operating activity, so we have a 10-year horizon, and here we can specify from the beginning of operating activity how many new customers are joining our project. So, and here we have a coefficient for all these customers to make us easily play with the amount of new customers that are joining our project. Also, we can specify different structure of the customers. So at the beginning of operating activity, we can have one type of structure. For example, the first 12 months we can have one structure of customers. During starting from the second year, operating year, we can have another structure of customers. So we can play with all these percentages, allocating them between different types of customers that we have. So this is very important because we can specify how many customers we have that would just stay with us without paying anything, and they will be gone, and how many, for example, if we increase this percentage, what will be the financial efficiency if we have bigger percentage of customers that don't pay us a penny. So this is very important. Then we have the table where we can specify where we have the coefficient for new customers for each type. So this is here we have coefficient for all new customers, and here we have coefficient for amount of customers for each type of customer. So we can increase or decrease the amount of customer for this or that customer type to see how this or that amount of customer type affect the financial efficiency. So for example, if we're too optimistic with customer type number 13, we can decrease the amount of customers. For example, take 50% here and see what will be the payback period if we have 50% of these numbers for customer type number 13. So it is very important for scenario modeling. So then we move to marketing. So for marketing we have different sources, different marketplaces, for example, where our customers come from. For example, they can come from YouTube, Instagram, Google AdWords, and different types of sources, marketplaces. And here we specify we have coefficient for them. Also we have a general coefficient for all marketing expenses. For example, if we want to increase or decrease marketing expenses, we can easily, for example, type here 120. This will mean that we increase our marketing expenses on 20%. Here then we have a timeline, 10-year timeline, the months of operating activity, and here is how we allocate new customers between these sources, between, for example, YouTube, Instagram, Google AdWords, and other sources. So, and this allocation may also have a dynamic feature, so we can, for example, during the first 12 months or 8 months, we can have one type of allocation. From the next period, we can have another type of allocation. Then when we allocated the percentages, then we specify the cost per new customer per each marketing source. So how much money we pay for one customer which comes to us from YouTube, from Instagram. So here we can specify the cost of acquisition of one customer from each source, and this cost of acquisition may have dynamic value. For example, during the first 12 months we can have one cost of acquisition here, then we can have another value of acquisition of one customer, and so on. So this is a dynamic feature. Then we move to payroll. So we have two types of payroll. The first payroll is directly connected with the amount of customers that we have. So here we type the name of position, then we specify the monthly salary, and then we specify the amount of customers per one person on this position. So this means that we need one person on this position per 2300 customers. So we can specify this value, and Microsoft Excel will automatically calculate how many people we need on each position to cope with all our customers, and we will calculate the dynamic direct payroll depending on how many customers we have at this or that moment inside the timeline of our project. Then we have two investment plans. The first investment plan is investment plan before we start operating activity. So here we specify what we invest in, here we specify how much we invest in and when we invest in, and this is the moment when we start operating activity. If we change the moment when we start operating activity on the top of the model, then these values will change here, and all investment plan will display to the left or to the right from this current point. So the next investment plan is the investment plan during the operating activity, when we start the first revenue. So here we specify what we invest in and how much we invest in, and when we invest in during the first 36 months of operating activity. So this investment plan is also linked to the moment when we start operating activity. We specify these values at the beginning of financial model. So this is completely automated story. Then we have fixed costs. So we may have some staged fixed costs. Here we specify what are the articles of fixed costs. Then we specify the month of operating activity when these fixed costs occur, and these are the values of these fixed costs. So at the first month of operating activity we have these values of fixed costs. On the third month of operating activity we have these values of fixed costs. On the 8th month of operating activity we have these values, and on the 12th month and further we have these values of fixed costs. So we can also change these values, change these values, specify fixed costs articles, and they will be completely automated. Then we may have some direct expenses depending on how many customers, not only new but current amount of customers that we have at a specific moment. So here we can specify the direct expense items and how much we spend on each customer, each current customer at any moment. So this is the spend, this is the item, and all these direct expenses are calculated also automatically. Then we have another type of payroll. We have a staged payroll. So these are the positions, the name of positions. This is the salary of one person on each position. And here we specify how many people on one position we have on the first stage, second stage, third stage, fourth stage. So these are the people on each position. And here we specify when this stage starts. So the first stage starts at the first month of operating activity, the second stage starts at the third month of operating, this is the 7th month, so we can also change these values. Then we have the block for the loan. Here we specify when we get this loan, year, month, how much, what is the value of amount of loan, interest rate, term of the loan, grace period for principal payments and interest payments. Then we specify the values of revenue tax, profit tax, payroll tax, asset tax, and then finally we have the cash flow statement, where we can see how much our own funds we need to start the business. If we have a loan, we can add this loan to our own funds and see the total amount of financing needed for the business idea. Here we can see the structure of revenues, direct expenses. We can press plus and see the detailed story of the business. So all revenues and expenses are detailed. Then we have on the next spreadsheet we have a simple table where we can see the total revenues, total expenses, profitability. Then we have a diagram with the simple and discounted payback period. Then we let him just calculate the story. Then on the next tab we have we specified the discount rate and the pace of changing the discount rate to reach the internal rate of return. And then at the end we have a sensitivity analysis block where we have the current financial efficiency, internal rate of return, profitability index, simple and discounted payback period values, net value, net present value, total financing needed for the business idea. And then here we can specify if we want to create some stress tests. So for example, we can take some inputs in our model, add this coefficient to this input, and press sense button and see what will happen to the business idea, what will happen to these values if the coefficient increases or decreases. So we can set up the pace of changing of this coefficient. So how it works, for example, I would like to see what will happen with financial efficiency if I, for example, add a coefficient to this value. I will add the coefficient to the payment of customer number 13. So I just go here, press equals, multiply it on this coefficient, press enter. So now coefficient is added, and now I'm just going back to sense and press the sense button here, and we will see what will happen with the financial efficiency if this or that if this value increases or decreases. So we can also, for example, we just want to copy, paste this number. So we deleted coefficient from this value, and we want to add a coefficient, for example, let's add coefficient to the amount of new customers. So we just take this, multiply it on coefficient, press enter. And now we will see what will happen with financial efficiency if we increase or decrease the amount of new customers in our project. So we just have to press sense button and see what will happen. So now we see how increase or decrease the amount of new customers affects the financial efficiency. So you can add this coefficient to any parameter of inputs, absolutely any parameter. Press send button and see what will happen to your business idea if this happens or that happens. So this was subscription financial model. I will give all the links to the creation of this model at the description of this video. You may give us a like, subscribe, share this video with your friends. You can write a comment, or you can order a financial model from scratch for your unique business idea. Soon we will start a new project. I will be modeling housing projects. So see you next videos. Thank you and bye.